Hi everyone, my name is John Maher and I'm the Chief Investment Officer at CCR Wealth Management, and I'd like to thank you for joining us today. Nearby you're going to find four separate videos that we recently filmed. We're going to talk a little bit about interest rates in today's environment. We talk a little bit about a meeting we had with PIMCO Group Chief Investment Officer Dan Iveson and some of the comments he's made about the credit markets recently. Also discuss not so much an update, but a general overview of tariffs in general and how they pertain to our current trade dispute with China. And lastly, there was some questions received from our clients about the general concept of ESG investing. So if you're curious about that, please take a moment, click through. None of them are particularly long. Today is July 15th. And the last time I think we did this was roughly 12 or 13 weeks ago. I ended that short segment with a prediction that given the fact the S&P 500 was up 14 or so percent in mid-April, that we should all likely expect a bit more volatility and a full year return that really doesn't look like the first 1.5 quarters of the year. So fast forward 3 months. In the middle of July, we have a Dow Jones Industrial Average that's up 19%. The S&P 500 is up over 21%. And of course, the NASDAQ is up almost 25%. Adding to that, I would look at the bond market and tell you that the bond market, the aggregate bond index is up almost 6%. So clearly my short-term prediction in the middle of April hasn't panned out, and that's the danger of making short-term predictions. We don't do that at CCR Wealth Management. We certainly wouldn't place our clients' assets in a position to either try to benefit or avoid very short-term things. There are some things that haven't changed over the last 3 months, one of which is the ongoing trade dispute with China. We had near resolution. We had a pulling back from that resolution, and of course now, since the G20 summit meeting, we have kind of a continuation of topics. This has been going on for 7 months now. We expect it's going to continue to go on for some time. The other thing that hasn't really changed is a narrative that perhaps louder today, but is roughly the same as it was in April, a narrative that lower interest rates are coming. So at the end of this month, July 30th and 31st, the Fed governors get together in something called a Federal Open Market Committee meeting, and they'll decide whether they're going to lower interest rates at that meeting, and if so, by how much. They meet again in September, they meet again in November and December of this year. There is a narrative. And the narrative is a story, and the story is how people think, and it's kind of being spoon-fed to everybody that the Fed absolutely 100% will be cutting rates at the end of this month. I am of the opinion that the data do not support a Fed rate cut. However, I am not a member of the FOMC. But it is undeniable that most of the economic data that we've seen in U.S. markets this year, with a couple patchy exceptions, are supportive of describing this economy as fairly solid. Non-farm payroll numbers that describe the labor market, as well as inflation data that was released last week, all show a fairly benign economic picture here in the U.S., despite the slowing that we do know is going on in the rest of the world. So here, with market indices at these levels, my description of year-to-date returns would be, look, last year was not only a negative year in the stock market, it was a down 20% or so year in the fourth quarter. A lot of these year-to-date numbers are, in my opinion, reversion to the mean. How much organic good news is priced into stocks? Well, we'll all be the judge of that, but the narrative of a Fed rate cut is definitely pushing equities to all-time highs in the case of most indexes. So having said that, we do expect market volatility to continue and perhaps pick up throughout the rest of the year. Short-term predictions are, as I've said, not the business of CCR Wealth Management, but I'll tell you personally, I will be surprised if equity levels or equity returns for the year even match what we have here in the middle of July. In this market environment, good news seems to be bad news, and bad news seems to be good news. Any data point that supports an economy that is strong and positive seems to be met with negative moves in the stock market, and that's because of the likelihood that the Fed will then decide they don't need to cut interest rates. This is called the Fed put, all right, and this is the role the Fed seems to have played over the last 10 years in riding to the rescue every time there is a data point that the market doesn't seem to like. That is perhaps a moral hazard, but it is something we're going to be having to deal with for the rest of the year and certainly into next year. So with that, I would add that nearby you're going to find some recent videos we just filmed, and if you have a curiosity about any of them, certainly click on. I talk a little bit more in depth about interest rates, the Federal Reserve, and kind of where we are in the economic cycle. In addition to that, we had a sit-down discussion with Dan Iveson, who is the Group Chief Investment Officer at PIMCO. So he's someone who manages quite a bit of money, and he's got some interesting input. We discuss in broad terms tariffs, as well as kind of where things stand and what's the end point with China and what happens with the increased costs associated with tariffs. And lastly, because we've had a number of questions with regard to kind of what is ESG, we discuss environmental, social, and governance criteria in investing. So hopefully you find some of that information useful. I look forward to talking to you the next time. If you have any questions, don't hesitate to call your advisor, and good day.